Good afternoon all, this is Trader72. Welcome back to my YouTube channel. I hope you are all well on this fine Tuesday afternoon. Time already flies. This is a one-off analysis video that I did mention in my previous videos like yesterday, my morning and evening diary. We are now going to condense it down to one show a day. I think that makes it easier all around to do so. And without further ado, let's move on to my 5 opportunity stocks, which I've mentioned in my thumbnail, which I'm sure you guys have seen now. Really, today is just to look at 5 stocks that have basically recently pulled back and could be an actual opportunity to buy in. These are not just random companies, they're quality companies with huge moats that are in slight distress and are worth looking at in terms of that side of it. I'm going to break them down. In terms of stock price, and as you can see here, from business breakdowns to why they're down, intrinsic price versus MOS, 4Ms, which is the 4 matrix that I abide to, financial matrix, debt versus equity, which obviously is important, latest news links, and just a few key financial numbers that you should look at from the balance sheet. Now, most of you can probably delve more into detail. Please, obviously, these are just my thoughts, my advice on what I think the stock is at and what you should be buying at. And please do your own due diligence, obviously, before buying in. I'm only here as an advisory. The important thing is to match the actual stock price with the actual story and what's behind the company. And that's the important part, not just looking at overprice, buying into companies that are overpriced and overvalued. This is all to do with its intrinsic price, which is the true value of the company based on a DCF model, 10-year DCF model, which I've already mentioned and taken down, which most value investors or good value investors, especially very long-term value investors, probably longer than I am, buy into as a system. There's many different systems out there you can work in intrinsic price, but this is the one I feel is the most, the truer ones for me anyway. So from that opportunity, let's look straight away at the 5 that undervalued stocks that I've mentioned. So Microsoft's number 1. Now, there's no particular order on this. This is, as it is. But Microsoft, we all know what the business does. Azure, it's obviously Teams, LinkedIn. It's a huge it's a huge company. The intrinsic price is currently at 560. This is based, again, as I said, on a DCF model based on specific growth. Now, this is obviously can move around. You can maybe believe a little bit more. You might think that it's more conservative, or you could go slightly higher than I've based it on. But this is not about details. This is more about the actual intrinsic value, what we worked it out with. Please do like I said, your own diligence if you want to do your own intrinsic price based maybe on a higher growth or lower growth. But that, I feel, what we've worked out so far is what we feel the growth of the company is at based on the last 10 years to the future 10 years of DCF, which is the discounted free cash flow. So why is it down? Well, we pretty much know why it's down. Again, in a nutshell, heavy AI spending, capex is huge. All 6-7 of the big boys have basically spend a heck of a fortune. I think over $600 billion. But most of the biggest one so far is Microsoft, which was slightly lagging behind, I think, in AI infrastructure, and are now catching up. But they've paid the price for that, because obviously the more they spend, the more people want to see what is the AI monetization going to be, which is obviously a translation for how much money can you make from building all this in terms of AI infrastructure, in terms of the Azure. Obviously, it's a very competitive mode as well. I mean, there is a competition, especially from the storage side, but they've got OpenAI as well, which obviously is involved with that side of it. Again, we can go into this more if you guys really want me to as individual stocks. But for now, the AI spending has certainly affected the market. They came out with great trading update in the recent season of updates, but that has hammered them in terms of share price. They're at almost a 52-week low. Currently, so the intrinsic price of 560, the MOS is in between 25 to 30%, depending on where it's at, 392 to 420. Currently at $400 a share. That is a bargain right now, as you can see from the the 1 week chart, currently high of 551, just sitting just on top of that 200-day moving average, and it's still in heavy set oversold and heavy selling on the MACD. So at the moment, I can't see the share price going that much on the up, but when it does, when it's ready, that stock price will go back to, I think, 480 to 500. So again, the margin of safety, which I think is very important to explain, 25-30% is probably a decent amount. Some investors like 40 to 50% to make sure, but do not do the mistake I made with Adobe when I bought at 10% and it went further down, a falling knife. And so the whole idea is that you buy the stocks, and if it does fall, it will hurt, but nowhere near as much as if you buy it when it's overvalued. So I think the point to this really at this moment is that it is a good price to buy in. So definitely worth a punt there. Now let's go back to the actual M&A, the four M's, which is meaning, moat, and management. Moat is, for me, one of the most important in terms of defense of what it's about as a market. It's a dominant market player. It's one of the big boys in that market of cloud compute, AI and cloud storage, and obviously computers and licensing, and it's unbeatable. And I think the network effect is huge. So MOS, that all qualifies. ROIC, which is the most important one I look at, which is a minimum threshold of 10%, is at 26 to 30%. Outstanding. Free cash flow, 18% of free cash flow. Outstanding. Free cash flow being king for me in terms of lifeblood for the company. Debt versus equity is super low, under 1, so 0.3. So it has literally a minimum of debt and probably can pay its debt back within probably a couple of weeks, or even certainly less than a year. And again, that's something I look at in terms of, I like to buy into companies that have very low debt leverage. So that definitely qualifies for that. The rest of it, as you can see, gross margins outstanding 68.6%, profit margin at 39%. So for every dollar they make, 68% is gross margin, which is amazing. So P ratio, currently you're not going to get P ratio on Microsoft for a long time yet, at 25 compared to some of his peers, but again, outstanding. I can go through the rest of it, but the takeaway of this is high quality business globally, strong matrix, low debt, makes it an ideal MOS, margin of safety. So that's my first one. I would seriously suggest looking at Microsoft. It's at to almost a 2-year low, but it's not just, don't base it just on that. Base it on its fundamentals, base it on the business, and base it on the future growth of this company via its DCF, and you will see a true share price, and the intrinsic price is the true share price of the stock. Unlike what Mr. Market, I call it Mr. Market because I think Phil Town in his book Rule 1, which I should definitely read, called it that, where the market gives you a price, but their true value is based on obviously free cash flow, which is, like I said, the lifeblood of the company. So that's number one. Number two, another huge moat, Visa. Now, Visa Global Payment Network earns fees on transaction throughout the world. It has talk about huge network effects. It is, almost a duopoly with obviously MasterCard. It runs that sector. It's global. It's worldwide. Every transaction right now, as we speak, is going through. They're making money every second of a transaction used between merchant or customer or inter merchants. It's the moat is huge, and it has been for a while. Now, why is it down? Regulation concerns, fintech competition, market rotation. Europe wants its own credit card. It's trying to making noise about that. Trump wants to obviously cap interest at 10%, which is a disaster specifically for banks, not so much for the credit cards, ironically. But again, worth looking into. So again, I'm giving you an oversight here. Please, if you want me to go into more detail, I can certainly do that. Make your comments below. So that is, I think, the three issues there and why the share price is down at this moment. Intrinsic price 440, MOS 330 to 308. I think it's got about 25 to 30% discount. You're not going to get Visa at that discount for long, I don't feel. Obviously, if things newsworthy do affect it, it could be there for a while. It could go down further. But eventually, Visa is, even with the situation with stablecoin as well, which obviously has risen, they have their own stablecoin now, and they adapt. They have adapted all of the span of history from the 40s, 50s onwards, where Visa and MasterCard have just grown and grown, and there's been many complications in the past, and it has survived. So my point is that because of its pure name, network, and business as a major player, I think it will be very hard to displace that at the moment. ROIC 35%, well above the 10% growth. EPS growth there, 16%. Free cash flow 14-16%. Obviously, it has a different type of debt to someone like Microsoft or UNH, which we'll talk about in a minute. It is obviously a cash flow movement situation where the cash goes in and out. So there is obviously some kind of debt involved. So it's very hard. But I wouldn't, in terms of the debt versus equity, I think it's pretty second to none anyway. But it's to be expected with a credit card company from the nature of the business. P ratio currently at 29. I think it's actually even less than that now based on the share price. Takeaway, global tool booth business. That is basically a business that just makes money and prints money like a tool booth does at a motorway. It's unbelievable the amount of cash it generates from everybody using it constantly. I know I do. I've even used it today, I think, this morning. So definitely a very strong moat. Duopoly with MasterCard and obviously American Express, but mostly these two. And very much like S&P Global that I own, between them and Moody's, where the credit rating, they actually own that market. Quick look at the share price. Again, Visa at 309. I bought into it last week, my first tranche, and I will buy more if it drops further down towards 300. But again, at a 52-week low, not 5 is 200 moving average. And like I said, you can see there the average is around 350 to 380 a share price. So definitely an upside there. United Healthcare, one I owned last year, made quite a bit of money on, should have probably made more. Story for another time. Intrinsic, so obviously it owns United. It's the biggest healthcare company in America. It owns health services such as Optimum, data pharmacy, care delivery. It is a huge conglomerate, a huge foothold, especially in America, more than anything else. Too big to fail in my estimation, but obviously it has its own issues like the other two I've just mentioned. Rising medical costs, regulatory pressures. Obviously the DOJ, there's a DOJ situation going on at the moment where there's a mass investigation over quite a few scandals, price misleading, the CEO being killed last year by somebody on the streets. That's obviously aside, but there've been just one after the other, and the share price went from about 600 to now pretty much 286 the last I saw, so almost halved by 50%. It has also regulation. I think Trump put the boot in by offering Medicare only, giving money of 0.09% instead of the expected 4.6 to 6% that was expected by the market, obviously, to fund the healthcare. It's very complicated business. You do need to know about it. It took me a while to understand how it works, especially in America, being in London. But it's definitely worth a look at this business because it is, at the moment, as it stands, around 550 intrinsic price, and it's currently over 30% discount right now based on its intrinsic price. It actually says 412 to 385, but the actual share price is currently at 286. So you're looking at almost 40% discount. Again, I can give you more detail if you need me to give you more exact numbers, but definitely in that ballpark. ROIC, very good, 22 to 26%. Obviously, the pressures of what they're making in terms of margins is gone from 86% to now 89%. So for every dollar they make, they only make about 10%. So it's quite a low amount now, and they are definitely under pressure. Aging population as well, lots of combination of things. You guys should definitely look into this in terms of more details, but I think it's still an amazing business that will grow back and will get back itself on its feet because it has more than just healthcare. It also has a pharmacy. It has, lots of different businesses under one umbrella, and that is always a good thing. So I think maybe no growth this year. I think it's a long-term one, this one, in terms of patience. I certainly waited for nearly 6 months last year when I bought at 242, and I bought quite a few tranches to even get to 385. And I think it will go back to about $400 a share eventually, depending, of course, on news and what will happen with the DOJ court case overhanging, which is a big thing because it could just get a slap on the wrist or a fine. I think in the long run, it will get a massive fine and it will move on. I think that's what will happen. But we'll see if the Senate goes after them or not in a bigger way. Defensive giant with scale, strong cash flow, solid balance sheet. Yeah, I mean, I was going to say Visa and UNH are probably more defensive stock, so less volatile towards the market, which is why you calculate the thing called the beta, a matrix called the beta, which is anything under one is more defensive and more steady when the markets are volatile. Although United Healthcare can go up and down on the market depending. I think it's just above 1, but still a defensive stock in the view of the thing. Uber. Now, Uber's a slightly different out of the other three. Less of a moat, more competitive market. It obviously does delivery services. It competes against obviously lots of different services. Also, robo taxis as well. There's the other thing that is quite a competitive market. As you will see from the 4Ms, only 2 qualify, but I still think it's a great business for the future. The ROIC is also weak. It's under 10%, but it was in negative free cash flow and numbers up to only 2 years ago, and it has turned it around. It's an amazing business. It now makes quite a bit of money. The free cash flow is in positivity, but as you can see from that, it's just turned it in the last few years. As you can see, the free cash flow growth strong recently. Sales growth is up 22%. Debt versus equity, it has got a bit of debt compared to maybe the other three, so that's maybe to look out for. And like I said, the 4Ms doesn't quite, obviously management has made some good decision. There's a lot of litigations against Uber for various different reasons. Europeans, in terms of the way they use the Uber drivers. The Uber drivers are not always happy as well. Allegedly, I'm just saying allegedly. And obviously a few other attacks by Uber drivers on women as well, which recently has come to light. And I think they've recently won a court case. So there is a lot of issues in the background, but who hasn't? If you mention a lot of the bigger companies, always this is a part and parcel of the game. Again, revenue up, profit margins at 19%, pretty damn good. High potential platform, still proving its quality. Debt slightly higher, so risk is elevated. So it's probably the more risky out of the three so far. To look out for, but I think the potential is massive. Bill Ackman thought so. He bought a huge amount. He sees it going at north of $100 a share. So again, the margin of safety on Uber is at 50 or 45 to 50%. It's considered at 129 margin of profit. Actually, it's not on there. Again, if you look at the share price, Uber currently at 79, moving really quite quickly actually today, and it looks like it's going into buying at this moment in terms of momentum. So definitely something to look out for the future. And I think Uber is definitely one of the 5 that's undervalued considerably. On to the next one. Now, least but not last, Sprouts Farmers, health and focused grocery chain. The only retailer out of the 5. I like this business. It's niche. It's organic. They produce their own products, which is why their margins are very high. Intrinsic price currently at 118, has had a few issues with trading update back in Q3, litigation against them as well in terms of going forward, misleading some of their investors, allegedly. Again, I will say in Q3, so there is some kind of court cases going on, gathering with shareholders, deeply unhappy shareholders, but it is still a good company. It's obviously cyclical, so it does go up and down based on season and also consumer spending, which at the moment could be sticky point with inflation going up because of the currency issue with crude oil, but also the fact that we are in a sticky inflationary market. So that's to bear in mind. 4Ms does qualify for meaning, obviously. Moat, smaller moat than the other 4, with the other 3 certainly. With Uber, definitely a smaller moat there because of the market they're in. Obviously, it's quite competitive. Management is great in terms of decision making, although they've had a few issues with this litigation, so that could be questionable at the moment. Again, unproven until guilty, and that is ongoing. So please do make your homework on that side. RIC, amazing margins. This is probably one of the main reasons why I picked Sprout quite a while back. 22% ROIC for a retailer is amazing. Equity EPS growth 12 to 15% going forward. Free cash flow at 11%. Very, very low debt, which is also very good. 0.4, as good as Visa or even Microsoft, for that matter. And as I said, gross margin is 38%. That's a pretty big margin for a retailer. But again, due to the fact that they produce their own vegetables and organic vegetables, and that makes a head of a difference in terms of margins, unlike the Walmarts of this world and everything else, which they have their own organic, but obviously buy a lot of products themselves from other companies. P/E ratio at 15. So again, I like the look. Solid niche retailer, healthy balance sheet, but slower growth than the elite names. So I think that's kind of where we are at with that one. As I said, litigation is ongoing. The share price is currently at 82, so it has bounced back from its lows of 68. Again, I would probably look at my buying again around the 80 mark, 78, 80 mark. Uber, I would look at early 70s before I kind of look at it. Again, it's on my watch list. Visa, I'll certainly buy if it goes lower. United Healthcare, probably around the 280 would be where I look at the moment. It's just bounced off because obviously today is a good day in the markets. And, well, Microsoft I definitely would buy right now. But that obviously is down to my location where I've already spent quite a bit of money on other stocks. So for you guys, maybe a better opportunity than me at the moment, especially if you've got the cash available sitting on the side. That is the 5 stocks I would definitely be looking at. So those 5 stocks I think are worth watching right now. Some of them are down, real concern, other just on the market sentiment. Let me know what your thoughts are down below in terms of comments, whether or not you want me to look at individual stocks, the individual of any of these 5. And this is where I feel this is all about, obviously, patience, waiting for the right opportunity. But obviously do not look at short-term movement of the market. If you're going to do the value investing, it is very hard to do sometimes, but maybe ignore it and, go with your research and your thesis on the actual thesis of the company. And at the moment, I feel those 5 are definitely worth a look at. So I hope this was helpful. This is Trader 72. I will be back with further analysis this week. I might be looking at Lululemon this week if anybody's interested. And obviously the end of the trading season is coming to an end this week pretty much. So that will be it. And I may well come back up again with my evening diary on the market. The markets are looking green today, which is good news. So that is a bit of good news. 2 days on the trot. Even my stocks are up. So I may well give you a quick update on that and my portfolio eventually, probably tomorrow. But on these wise words, it's over and out from Trader 72. I hope you enjoyed my analysis. Please subscribe and like. That would be very helpful. And like I said, any comments below, please. We'll go from there. Take care, guys. See you soon.